Adam Geller with PCE Investment Bankers. I'm here to talk about a subject that I'm passionate about, ESOPs, or Employee Stock Ownership Plans for the uninitiated. Today, I am discussing the 5 most important factors to consider when deciding if an ESOP is right for your company. If you don't know what an ESOP is, I suggest you hit pause and check out the videos linked in the description before continuing. If you feel comfortable in your ESOP basics, then I invite you to stay with me for the next few minutes. In short, ESOPs are a financial instrument allowing owners to receive liquidity while employees receive the benefit of ownership. It really is one of those rare win-win situations in the financial world. The way to make sure an ESOP remains a win-win situation is for all involved parties to understand the factors we're about to discuss and be realistic in assessing the company along with its value and future growth potential. The first factor to consider is the size of your company. Not every company is the right size to become an ESOP. Typically, it's best if your company generates at least $1 million of EBITDA annually. Additionally, as ESOPs are regulated by the Department of Labor, it is highly recommended that only companies with proper human resources and accounting resources explore this option. Also, companies that have less than 20 employees are typically weak ESOP candidates given the potential difficulty in remaining compliant with certain ESOP regulations. The second factor to consider is the stability of your company's earnings. Companies with unstable annual earnings or lack the ability to grow are not suitable candidates to become an ESOP, as they do not provide employees long-term security in their ESOP retirement accounts. Factor number 3 deals with the strength of your management team. The best companies typically have strong leaders in place to guide the company, as well as a strong pipeline of future company leaders. Factor number 4 is to evaluate your company's risk profile. Given a company incurs debt obligations as part of an ESOP transaction, it is paramount that the company have the right risk profile along with the right human capital in place to navigate the future once the firm becomes employee-owned. The 5th factor, long-term growth potential, acts as a culmination of the previous 4. If your company struggles in areas like profitability, stability, management strength, or risk profile, it likely doesn't have the potential for sustained growth either. Think of retirement accounts as a safety net for when work is no longer an option. Like other retirement plans, ESOPs leverage the power of compound interest over time to provide significant benefits. However, since ESOPs invest in your company's stock on behalf of employees, that stock needs to have inherent value in the future to hold any worth in the present. In the end, ESOPs are a unique tool that can generate liquidity for owners who want to sell and allow employees at all levels of a company to participate in long-term, tangible wealth creation. At PCE, we're passionate about helping businesses and their employees thrive through ESOPs and welcome the opportunity to assist you, your company, your employees, and your future ESOP. Thanks for watching this video. Be sure to subscribe and leave your comments below.